Hi, my name is Ramsey, and today we're asking, is a massive tech bubble building in the stock market? It's a popular narrative in the media right now with nearly 50 million current news stories on the topic, as technology stocks have seen unprecedented gains in recent months, leading some analysts to speculate that a bubble similar to the one seen in the late 1990s, which ultimately ended in the Nasdaq crashing nearly 80%, might be inflating again today. Opinions are all over the map. Is the tech sector headed for a crash of dot-com bubble proportions? And if so, what can you do to prepare yourself? Full disclaimer, this video should not be taken as financial advice and it's for educational purposes only. And although I'm employed in the wealth management industry, my YouTube channel is completely independent and it's just my way of sharing with you some of the information I've learned in my 8 years working for some of the largest financial institutions in North America, which I hope you'll find helpful. Any opinions expressed in this video or on my channel are my personal opinions only, and end of the day are just my 2 cents. There's no denying that a tech frenzy has taken over Wall Street by storm in 2020. Trends like work from home and cloud computing have driven investors to pile into tech stocks like Apple, Microsoft, and Amazon, viewing them as companies best positioned to withstand the coronavirus pandemic. In a year where unemployment reached Great Depression-like levels and food insecurity ballooned, the FANG Plus Index, which consists of the 10 most highly traded tech giants, is up 100% year to date. The US technology sector has surged past a $9 trillion market capitalization, making it more valuable than the entire European stock market. Apple's market value alone, after the stock rallied nearly 70% this year, has surpassed $2 trillion, the first time in history that a US company reaches the milestone. Apple is now worth more than the GDP of Canada, Russia, Australia, and all of these developed countries, just to name a few. So, what is a financial bubble? Surprisingly, there's no formal definition, but economists generally agree it's when there's a significant increase in the price of an asset that doesn't reflect an increase in its true value. Bubbles have been around for centuries, with evidence dating back as far as ancient Babylon. They usually begin innocently enough. There's a new product or technology that attracts the attention of early investors, and the market starts off small with low prices. Media coverage and word of mouth increases as prices start to go up, and this lures in new investors on the belief that they can make easy money. They buy the asset without an understanding of what they're actually buying for the simple reason they believe they'll be able to sell it for more in the future than what they bought it for today. The fear of missing out on future gains and hearing stories of friends and neighbors making money doesn't help either. Prices then skyrocket at an illogical rate, and some investors, called the smart money, worry things are getting out of control and they sell. Now they're the lucky ones, because the final stage is where it gets scary. Panic. The masses realize that the market is way overvalued and they rush to sell their investment at the same time. This causes a bubble to go pop and sends prices crashing. It's investor psychology at its finest, or worst, depending how you look at it, and the impact of the burst can be devastating, just like the 1989 Japanese debt bubble and the 2007 US housing bubble. Now, depending on the size of a market and how liquid the asset is, a bubble can take anywhere from days to years to play out. Another thing to note is that they're rare, and they occur just infrequently enough for us to forget the last one, at least until the next one begins, which is what makes it so easy for people to say, this time will be different. Given the context, let's discuss one of the worst stock market bubbles in US history that today's environment is being compared to, the 1990s dot-com bubble. So let's flash back to the 90s. The internet was in its infancy, and excitement surrounded companies like Pets.com and eToys, who were promising to change the world. The Nasdaq, which is an index housing the biggest tech stocks, soared 500% between 1995 and 2000 as investors and venture capitalists threw their money behind any tech company they can get their hands on. And startup companies without any proprietary technology were skyrocketing and spending fortunes, up to 90% of their budgets, on marketing to establish brands that would differentiate themselves from the competitors. The symbolic moment of an investment bubble grown to unsustainable excess came in January 2000, when 17 dot-com companies each paid more than $2 million for 30 seconds of advertising during the Super Bowl, only to go out of business a few months later when the Nasdaq crashed 34% on its way down an eventual 80% spiral. Thousands of online businesses were wiped out, trillions of dollars in wealth disappeared, and the same companies synonymous with the early dot-com success became symbols of its eventual failure. The Nasdaq took 17 years to recover. In March of this year, on the 20th anniversary of the dot-com crash, the Nasdaq plunged 32%, and it felt like deja vu all over again. But the index has since recovered, even exceeded pre-pandemic levels, thanks in part to numerous economic stimulus initiatives implemented by the Fed and by Congress. But some investors remain on high alert given how fast and how furious tech stocks have rebounded this year. But given the similarities between today and 20 years ago, their concerns aren't necessarily unjustified. The Nasdaq is trading at all-time highs. Enthusiasm for tech IPOs are at levels not seen since the dot-com crash, as companies like Airbnb and DoorDash doubled in their stock market debuts, with the soaring share prices baffling their own CEOs. Investors are buying tech companies on promises for technological advancement rather than business fundamentals. Stock market leadership is thin, with tech stocks accounting for 40% of the S&P, eclipsing the 37% record from 1999, and tech valuations are approaching levels not seen since the dot-com bubble, making Amazon founder Jeff Bezos the richest person in the world, and Elon Musk, thanks to Tesla's skyrocketing share prices, which have more than six-folded this year, the second wealthiest person in the world. Last but not least, the dot-com era was famous for bringing in a new wave of retail investors who took advantage of revolutionary trading platforms like E-Trade, which allowed them to buy and sell stocks online instead of going through the hoops of calling up a broker. New retail investors are flooding the stock market in record numbers once again, this time aided by the popular trading app Robinhood, which has democratized trading even further by making commission-free trades the norm in the industry. There's no shortage of headlines to suggest that this is dot-com deja vu, but as crazy as things may be, there are some differences that suggest this rally is made of much stronger stuff than the one which popped 20 years ago. First, the dot-com rally was comprised of young startups with questionable business plans, like Pets.com, which went out of business just 9 months after its much-hyped IPO. Today's technology firms have attained a level of maturity that almost no dot-com companies had. They go beyond tech, and these companies have become a vital part of our everyday lives. Second, the average age of a company going public at the peak of the dot-com bubble was just 5 years, and it's been double that for the past 10 years. Tech companies that imploded in the dot-com era, like Pets.com, which had just 1 year of operations and $6 million in revenue under their belt before going public at $300 million valuations, are unlikely to have ever IPO'd in today's environment. Third, the 90s rally was driven by a mania of speculation about tech's future. Ordinary investors drove up the price of internet-related companies for no other reason than it was the internet. Companies boosted their share prices and attracted investors by simply adding .com to their name. Revenue didn't matter. If you registered a domain name and you announced that you were starting an innovative internet business, venture capitalists raced to give you their money. Generally speaking, today's rally has fundamentals and corporate earnings supporting it, and it's being driven by some of the largest monopolistic market powers that the world has ever seen. They're real businesses with an actual product and actual cash flow. And while some popular tech stocks could very well be overvalued today, many are generating profits on a scale that internet companies of 20 years ago could not imagine. Fourth, tech stocks are not as overvalued as they appear. During the dot-com era, the Nasdaq Composite's price to earnings valuations ran to 200, which means investors were willing to pay up to 200 times more than what a stock was earning in order to buy it. And although many of the stocks driving the rally today are at historically high prices relative to earnings, the index's PE is relatively tame in comparison. And fifth, is the issue of debt and central banks. The dot-com bubble was fueled in part by the Federal Reserve increasing liquidity to deal with the perceived threat of the Y2K bug and the long-term capital management crisis, which was a massive hedge fund that almost collapsed in 1998, and it would have set off a global financial crisis if it had. Low interest rates at the time made the stock market appealing to investors, but between mid-1999 to mid-2000, the Fed tightened monetary policy and drove up 10-year U.S. Treasury yields to 6%. Investors essentially woke up and thought, why take a 2.2% yield on these risky stocks when I can get a 6% return from risk-free bonds? Stocks were no longer attractive, and this is a far cry from today where stocks look far more attractive relative to bonds, and they're likely to stay that way for a while, as indicated by the Fed. And this is significant. Investors really don't have many options outside the stock market, and it implies investors can justify today's stock prices based on those grounds. So, are we in a tech bubble? For as long as bubbles have been around, so-called pundits have been trying to spot them before they happen. But they're notoriously hard to recognize while they're happening, but they always seem obvious after they burst, thanks to the benefit of hindsight. Even Charles Mackay, one of the most famous critics of bubbles, who wrote the book on how to spot one, managed to fall for the biggest bubble of his time, the 1840s railway mania. telling British investors to buy railway stocks as they were soaring and that there was no reason to fear a crash just months before railway stocks tanked 66%. Investors should always guard themselves against the assertions of pundits who claim they can detect bubbles before they burst. The media has been predicting a tech bubble since the last one burst in 2000. While the media speculates about a bubble, one arguably underreported danger that's building is that the 5 largest holdings in the S&P 500 are larger and more concentrated in tech than any point in the last 30 years, including the height of the dot-com bubble. 5 mega cap tech stocks make up 21% of the S&P 500's market capitalization compared to 18% before the dot-com crash. This is important because it signifies the market can be vulnerable to a lack of diversification. This allocation poses a significant threat to investors going into 2021 who think they're buying a diversified basket of 500 publicly traded US companies, but are actually making a concentrated bet on 5 technology stocks. The worry is that a fire among a few giant stocks can set an entire neighborhood ablaze, as we've already seen at times this year. We've seen it in the past too. When the Nasdaq collapsed in 2000, the broader S&P also tumbled, and Canadians experienced a painful lesson in this during the dot-com bubble as well, when 40% of the Toronto Stock Exchange was weighted in tech, and worse yet, 35% in a single tech stock, Nortel. And when Nortel fell from grace, Canadian investors who thought they were diversified had more than 1/3 of their wealth completely wiped out. And with $1.1 trillion of investor money in funds that mimic the S&P 500's performance, a dangerously lopsided S&P 500 poses a huge problem. And in both situations, who ended up holding the proverbial bag? Average investors. During 2000, as the market began its meltdown, everyday people were the most aggressive investors in the dot-com bubble, pumping $260 billion into US equity funds at the very moment that institutional money was getting out. 100 million individual investors lost $5 trillion in the stock market by 2002, and 70% of 401ks lost at least 1/5 of their value, according to a Vanguard study. If you're an index investor, look beneath the hood of the funds you're investing in to ensure they're as diverse as you need them to be. The stock market may not be as overvalued as it was 20 years ago, but it's more concentrated. And if you're looking for exposure to ETFs that track the S&P, consider investing in a version of the index called the Equal Weight Index, which gives every stock in the S&P 500 an equal weighting. Nobody can for certain confirm if we're in a tech bubble or when it might pop, and a warning that this isn't the most exciting advice, so long as you invest in a widely diversified index fund, your recovery from the next bear market should be a lot faster than the Nasdaq's 17-year recovery following the bursting of the dot-com bubble. If the past 20 years have taught us anything, it's the importance of diversification and paying attention to valuations. Again, my name is Ramsey. Thank you for watching this video, and if you have any questions, feel free to leave a comment.